Peace, family. What's good? Dub Washington here for another amazing episode. And listen, family, I greatly appreciate the support that I've been receiving from you guys as far as the value that I bring to this platform. And my goal is to do two things. First and foremost, I want to ensure that everybody eats. And secondly, I want to make the banks compete to lend you money, family. So with everything that's going on in the space, I am here to provide you with pretty much no gatekeeping, just breaking down information in a digestible manner in which you can digest it. So today we are going to be breaking down some of the internal secrets that these banks don't want you to know, family. Like, listen, I would not be surprised if I have a few bankers reach out to me after this episode and say, listen, Mr. Washington, like, you can't be dropping these type of gems. So without further ado, man, let's just jump straight into it. And the first thing that I want to kind of address is everybody wants to go and get access to business credit with the lack of a personal profile structure. So before I really jump into auditing the banks and understanding deposit ratios and all of these different manners in which you should know before you go into these institutions, I want to discuss the personal profile structure and the importance that it has. So before you go into an institution, I would tell you that you should at least have a 720 plus FICO. Now, don't get caught up in the score versus the profile, but typically with a 720, it shows financial behavior that is responsible. So as you go into these institutions, just understand the importance of what your profile says about you. And I spoke about it on the previous episode where I was like, the quality of the accounts that you add on your profile will outweigh the overall score. Now, depending on if you're going for traditional lending or alternative lending, this will determine where your utilization needs to be at. So a rule of thumb for me is always keep your utilization under 10%. Now, if you're going for, I would say alternative lending, you could be upwards of 40 to even 50%. But we already know that going the alternative route will pretty much have some high interest rates, in which whenever you're operating in this space, we want to get access to capital at 0% interest for an extended amount of time. And I'm talking about 12, 18, sometimes even upwards of 36 months. And the next thing that we want to kind of hit on is the quality of the accounts. You don't want to be too heavily weighted upon installment lines over revolving, and you don't want to be too heavily weighted on revolving over installment. You want to have a great mixture of accounts. Now, once you go and establish these revolving lines, you now want to get to the installments. One of the plays that I spoke about on the previous episode is the pledge loan play, the certificate pledge loan, to where you can actually liquidate money from a credit card, then use it to go and build primary lines, right? So if you're not familiar with that, I dropped a crazy episode breaking down the ins and outs of that. So definitely go check it out on the channel. You will not be disappointed. So no matter what type of lending that you're going for, the banks are willing to lend you money. And the number one way to show that you are responsible with a specific form of lending is essentially already having it on your profile. The main reason why you guys are here on this channel is to get access to 7 figures in funding. You do not get that by adding credit builders on your profile. With all of this being said, that is just a quick recap of what the personal profile structure should look like. Now we get into the sauce. All I need you to do is say your grace before watching the remainder of this video, because I ensure that you are definitely about to eat off of this information. So first and foremost, I always ask my clients, my mentees, etc., whenever they are structuring a funding sequence, when was the last time that you pulled a bank's credit report? I always get a puzzled look whenever I ask these questions, like, what do you mean, like, when was the last time I pulled a bank's credit report? They have a credit report. The bank's credit report, also known as their CAMELS rating, is the equivalent of our FICO scores. So make sure you understand that acronym of the CAMELS rating of an institution, because it is going to tell you everything that you need to know about it to determine if this is a great business partner for you. And as we already know, family, banks are nothing more than our business partners. So whenever you walk into the institutions with this mindset, it puts you into a position of authority. First and foremost, audit the bank, pull their credit report. You want to go to iBankNet. Whenever you go to iBankNet, this particular website is going to tell you a lot about that institution, but the number one thing that we should focus on is the deposit growth. As we already know, fractional reserve lending is a real thing. The more deposits that a bank has on hand, the more money it can lend out. If deposits are decreasing, it's telling us that banks cannot continuously lend out money. These are very, very key components of a particular institution to determine if they're going to continuously lend out money or even give out high limits. Now, the next thing that we're going to get into, family, is something called the Texas ratio. This is so good right here, man. So the Texas ratio is the non-performing assets, but we got to understand what a non-performing asset is. These are essentially loans that has been lended out that has been in default, right? So anything that's more than 90 days past due, these are what the bank considers a non-performing asset. So to get your Texas ratio, we want to do the non-performing assets divided by its tangible common equity, also known as the capital adequacy. Remember, I told you about the camel score. This is so game, man. Capital adequacy is the C in that acronym. You feel me? So before we go too deep off into that, I just want you to understand that the Texas ratio will pretty much tell you how much financial trouble an institution is in. Go look up a bank's capital adequacy ratio, and this is going to tell you a lot about it. So whenever I say capital adequacy ratio, I don't want you to think in terms of the bank's deposits, because technically, hear me out here, technically deposits are a liability for banks and credit unions. Yes, I said that right. Deposits are a liability for banks and credit unions because it is a note that is owed to the consumer. Do not get caught up in the deposits thinking that's what I mean by capital adequacy. That is not what I'm saying. Now, the core capital is the net income. So check this out. This is great as well. How does a bank make net income? By lending out money. So they take a liability, lend it out to another consumer, and then they charge an interest spread on that. And then that's where they make the net income. That's the primary way how a bank operates. So not to go too deep into that, because I don't want to confuse anybody or even really take it that high, because we really on auditing the bank. Now, I hit on this before. Whenever you're going to these institutions, simply verify that they have the product that you are searching for, whether it's a business line of credit, whether it's a credit card, and if it's on the personal side and or the business side. We do not want to walk into an institution that specializes in personal funding and we're asking them for business funding. This is one of the best ways for you to get a low limit with a high APR. Now, once you have seen that they have the product that you are looking for, the deposit ratio was good, and you have pretty much got under 100% for the Texas ratio, now what happens here is that you have pretty much identified an institution that is healthy enough to take on your business. Because remember, family, we are auditing the banks. No longer do we go to the bank and beg them to give us money. We make them beg for our business. Another thing that I want to bring to your attention that a lot of you often skip over is that banks have internal algorithms to determine if the income that you use for an application is accurate. While they will never know what you really make, but let me take you in the mind of an underwriter, in the mind of an institution before they lend you money. If you are asking a bank to lend you $100,000, $200,000, and then the zip code that you stay in, the median value of the house is $100,000, and you've been staying in the zip code for the past 2 or 3 years, the banks are judging you by that, family. While they will never tell you that, I'm here to let you know that the banks are judging you by that. Also, outside of the zip code, what does the quality of the accounts on your profile look like? In your previous loans that you have taken out over the past 6 months. You're telling a bank that you make $1 million a year, $2 million a year, but in the past 6 months, you took out a personal loan for $15,000. You took out another personal loan for $7,000. You took out an auto loan, right, at a 11% APR or 10% APR, and then you got it over a 7-year term, and the car's only $25,000. It doesn't seem realistic that you make over $1 million in business, family. I'm just here to tell you what the underwriters want. From here, family, another topic that I want to hit on is early warning services. Just in case you didn't know, Early Warning Services, a secondary consumer report agency, and they house a lot of the checking account information that you provide to institutions. But hear me out. What you got to realize is that Early Warnings is co-owned by Bank of America, Wells Fargo, Truist, JP Morgan and Chase, US Bank, Capital One. So they are owned by these major institutions. So whenever you provide certain information to one of these institutions, believe it or not, family, they are sharing the information to the secondary consumer reporting agency, in which the rest of these banks have access to it as well. So make sure that you understand this. Whenever you're going to apply for, let's just say, Bank of America, and you provide a certain income to them, they can now share this information with Early Warnings, which their homeboys, Bank of America, Wells Fargo, Truist, JP Morgan Chase, Capital One, and Capital One has also bought out Discover. So now Discover's in the mix with this as well. Now, guess what? All of these institutions have access to your financial information. So keep this in mind as you are applying for these banks, whether you're going in a specific order or if you already have current relationships with these banks. I'm here to tell you what the banks don't want you to know, family. The next thing that you should kind of focus on is the max exposure. Now we dive really deep into the product and the requirements for it. Whenever you're going for a business line of credit, whenever you're going for a business credit card, a personal credit card, etc., you want to understand what the maximum exposure is, family, for this product. For example, what limit does your business credit cards go up to? 50,000, 100,000, 150,000? What limit does the business line of credit go to? Is it 100,000? Is it 200,000, etc.? Now, once you have determined the max exposure for the product, we now want to know what docs are required for the maximum exposure. A lot of people skip over this, as you may go for that max exposure, but if you don't have the documents required, you should not go for it. Because a bank or a credit union will tell you, hey, our credit cards go up to 150,000. But if you're going to request 150,000, they may request 2-year tax returns for you. But if you go and say, hey, I'm cool with having a $75,000 credit card, you may be able to leverage stated income. This is where you don't have to provide any documentation, and they're just taking what you say as value. So keep that in mind. Before you go for the max exposure, family, make sure you understand what documents are required. Because if you don't have those documents, you should not be trying to apply for the product. Now, if you do have those documents, by all means, go for it. But if you don't have it, getting approved for $75,000 on a business line of credit is better than not getting anything at all, because you tried to go for the max and you don't have the documents, or you don't have the required documents to obtain the $150,000. From here, what we want to understand is, what primary bureau do you use for lending purposes at your particular institution? But the thing is this, is the same bureau used whether I'm on the personal side or the business side? Is the same bureau used whether I'm going for a business line of credit or I'm going for a business credit card? Is the same bureau used if I'm going for equipment financing? So determining what bureau is going to be used for each individual product is going to be key. PNC, for example, if you go for a business credit card, they're going to pull your Experian. But if you go for a business line of credit, they will be pulling your Equifax FICO 3 score. So you got to understand, depending on the product that you are going for, what bureau are they going to pull? Because once again, one institution may pull different bureaus for different products. So family, another thing that I want y'all to kind of understand, that there are multiple versions of your FICO score. I've done an 800 plus FICO masterclass that I dropped on this channel, and it broke down how to build up each individual score of your FICO. Now family, as we navigate to something that is very, very important, is the application rules for particular institutions. First and foremost, determine how many products do they have in total. Do they have 2 credit cards? Do they have 3 credit cards? This is going to be very important as we progress to the reallocation rule that they may have in place, as we progress to the multi-entity funding that they may have in place, because you can go and get multiple credit cards, move the limit over to 1 credit card, close the second one down, and then go for that one at the later date. Listen, that was too much game, and let me get back into it. One of the application rules that you must understand whenever you are applying at an institution, whether it's a bank or credit union, you want to understand can you obtain multiple products with one hard pull? This is also known as a multi-dip, because some institutions such as Truist, such as American Express, such as Bank of America, they will allow you to get multiple products and they only pull your credit one time. But you have to understand, application rules are very important. How many products do you have in total? You have to make sure that the institution does not have what they call a parent-child relationship line. What this means is that if you go and access multiple credit cards from one bureau, BHG is notorious for this. If you go and get 2 credit cards with BHG, they will make you share the limit across multiple cards, which makes no sense at all. Now, as we transition to the next phase of the application rules, we want to understand, what are your credit limit increase rules? Whenever I'm saying credit limit increase rules, I want to understand how much can we increase the limit by on the credit limit increase and how often. Navy Federal, for example, they cap you at an $8,000 increase every 6 months. So the most that you'll be able to get from Navy Federal every 6 months is $8,000. You got to understand how much and how often. Other institutions, American Express, for example, they have a 3X rule. You can increase the limits on your credit cards every 6 months at 3X. So if you have a $12,000 credit card, you can go in and request 3X that amount, and they are more than likely going to lend it to you, assuming that you've been responsible with the relationship. Now, listen, if a credit limit increase will require a hard pull, sometimes it's better to go for a brand new product, get that limit, and then reallocate it over to the previous credit card if they allow it. So make sure whenever you are getting a credit limit increase to ask them, will this be a hard pull or is it a soft pull? That is very, very important, because you do not want to waste a hard pull on your profile by going for a $5,000 credit limit increase. Once again, it would make more sense to go and obtain a new product and then reallocate the limit from the new product over to the old one and then close the new product out. Listen, family, that's some game. But listen, man, let's keep it going. Let's keep it going. Now, what is the reallocation that I was just talking about? A reallocation means that you have multiple products with one institution and they allow you to transfer the available credit from one card to another, right? Or multiple cards down to one card. I particularly love institutions that have more than one product, right? Because I can leverage a 0% APR phase and extend it out even more. So if they have a reallocation rule in place, this means that I could go for a $10,000 American Express Blue Business Cash. And I also can go for American Express Marriott Bonvoy card, right? On the business side. What I can now do is take the limit from the Marriott card, and let's say they gave me $10,000 as well. I now take the $10,000 from the Marriott card, transfer over to the Blue Business Plus. Now I have $20,000 on one card that is 0% interest for a year. Another way that we could leverage reallocation is to bypass application rules. Bank of America is known for their 2-3-4 rule, which states that you can't get any more than 2 credit cards every 6 months, 3 credit cards every 12 months, 4 credit cards every 24 months. But what if you go for 2 credit cards the same exact day, get approved for, let's just say $10,000 on both of those cards. You then reallocate the limit from one of the cards to the other and then close that second card down, because technically you only have one card with them. Now you can open up another card that you wouldn't typically be able to get. So listen, family, reallocation rules are not just about moving the available credit from one card to another. It's also leveraged to extend 0% APR phases and bypass application rules, family. Like, listen, man, this is good. Now, we've determined that the institution is right for us. We see that the institution has a great deposit ratio. We checked that Texas ratio. We seen the non-performing assets is low compared to their many products that we can get over an extended amount of time. We understand the reallocation process, right? We understand multi-entity funding. Now what we want to do is determine, should we go for the max exposure? Because as we transition to the business side, what's going to happen now, family, is that Some institutions will put a UCC1 on your business, and you may not be in position to get a UCC1. If you're not familiar with a UCC1, in layman's terms, this is a lien on your assets. And if you have a UCC1 on the business, other institutions may not want to lend to you. So you have to make sure that you ask what amount will trigger a UCC1 filing. Now, what data do you report to the business credit bureaus? Because as we have transitioned to the business side, we got to understand this part, family. There's a such thing as business credit cards at 0%, but then there's another thing called true 0% business credit cards. These are also known as ghost cards, meaning that they don't report any information to the business credit bureaus or the personal credit bureaus. They only report negative activity. American Express is one of these institutions. They don't report any of the payment trends. They don't report any utilization on the business cards. They only report the instance that you default on it. Other institutions such as Bank of America, Truist, Wells Fargo, PNC Business Line of Credit, they're going to report the balances that's reflected on these business credit lines. So whenever you're going to other institutions and we're getting into our credit stacking sequence, what happens here, family, is that they're going to let other institutions know, hey, he's holding $30,000 worth of debt on the business line of credit. He's holding $25,000 on a business credit card. It's going to let the Small Business Financial Exchange, SBSS, the Equifax Business Failure Score, all of these business credit bureaus will be reporting the information on your business credit. And remember, family, whenever we're going to apply for business credit at any institution, they don't just pull out personal credit. They pull personal credit and business credit. They're looking at what your balances are reflecting, what's the payment trends. All of this is going to be very, very important information. So upon all of this information, family, you should be able to determine if the institution is right for you. How does the institution look on paper? Is the deposits going up? Is the deposits going down? Do they have the particular form of lending that you're looking for, whether it's personal credit cards, business credit cards, equipment financing, SBA loans, auto loans, whatever the case is? Does the institution have that? Secondly, you want to know, what are the application rules? How many products can I get from you? And then from here, you want to also understand, what is the maximum exposure? How much access to capital can I get from this one institution so I don't have to go and bank anywhere else? And listen, family, we do not want to forget. I want to end it with this. We must prep for the bag. Whenever I say prep for the bag, you want to make sure, one, that the personal profile is intact. Secondly, we want to build with a deposit relationship. Banks have what you call internal bank ratings, which judges you off of what is the average daily balance that you have in your checking account, whether it's on the business side or personal side, over the past 90 days. One thing that you can do is build a healthy deposit relationship, and you want to build it out over a 90-day cycle. We don't want to go and drop $10,000 into the checking account at one time and then let the account become dormant. So make sure you build a strong deposit relationship with institutions before you ask for the bag. And guess what, family? If you have access to capital, we don't need to just do this with one bank. We can do this with multiple banks, and that's why my 3-5-90 sequence comes into play, is that we got to strategically structure our funding sequences to maximize the bag. If Experian is your strongest credit report, you need to go to 3 banks, build out a deposit relationship with them. If TransUnion is your strongest bureau, you need to go to 3 to 5 banks, build out a deposit relationship with them for the next 90 days. If Equifax is your strongest credit report, you need to go to banks that pull Equifax. It's not rocket science, family, but this is one of the things that a lot of people are not doing because we want access to capital fast, whenever building with a bank is a long-term game. So listen, family, what I came through with today was to show you some of the internal workings of the banks and credit unions that they don't want you to know. But one thing I do is I ensure that everybody eats, and that's what I came through and done today, family. So listen, man, until next time, I appreciate you for tapping in. And in my words, everybody eats. Let's go.